In this video, we're going to take a look at the 8 best tips and tricks and tools to find out when is a trend turning on you and when it is time to get out or maybe get into a new trend. First off, and I really love this, it's the pivot point structure and pivot point rejection tips. So if you turn on your pivot points, this is the 1 hour chart and this is the daily pivot points. You will be able to see the pivot point structure, and in a trend what you will generally want to see is that the market is trading above a pivot point, and pivot points are retested as support in an uptrend and they are retested as resistance in a downtrend. When you see that the structure is changing and when suddenly, whereas here the market was really nicely retesting the pivot point as support, here the market is not able to stay above the pivot point and breaking below it, this can often be a sign that the market is turning and going from an uptrend to a downtrend. Here as well, the market is suddenly turning and trading above the pivot point, so this is a good indication that this trend, this downtrend, seems to be losing a lot of momentum, and maybe it's even time to look for times when the market is now retesting the pivot point from above as support. This could lead to a new uptrend. Here as well, on the left hand side, you can see the market is retesting the pivot points from above, rejecting them and trading above it, and staying above them and staying above them. This is classic in an uptrend. When you see that this flips and the market is then going down and retesting a pivot point from below as resistance, this is a good sign that the market is now shifting towards a downtrend. A very, very important signal is a pivot point rejection. And we could use a pivot point rejection as a trading strategy. If you're interested in learning about a pivot point rejection strategy, let me know in the comments below and I will show you in a separate video on how to do that. But for this video, it's very important that you activate daily pivot points and then pay attention to how is the market trading around them during bear markets and bull markets. Are pivot points retested as support and resistance? Is the market breaking through them? And this will tell you a lot about what is happening behind the scenes in the trending markets. Next on the list is the ADX hook signal. So we added the ADX, it's the 14 period, the default setting. And what you will see in a trending market, when the market is trending in either side, the ADX will go up, and the ADX going up means that the market is gaining strength and the trend strength is very high. However, when you see a hook, it shows you that the market is losing strength and that the trend is losing strength. That's a very, very important signal. And what you can do then is also add the pivot points, so we can really nicely start building the different confluence together. You can see here we added the pivot points and the market was trading below it because here the market was trading above it in an uptrend. Here is where the market rejected the pivot points for the first time, started trading below it in a downtrend, rejected it as resistance. And here is where the ADX hook happened and also where the market broke above the pivot point for the first time. We can add the 20 period EMA as an additional trend filter, and you can see here's a very important cluster, the 20 EMA and also the daily pivot point. Together with the ADX hook signal, that's a very, very important piece of information that you need to know. And you can see afterwards, here's where the market broke above it. Here's where the ADX hook happened with all the confluence. Then the market traded higher and this uptrend started. Here we have another ADX hook. You can see it here. And the market broke below it, retested the pivot points from underneath, broke below the moving average, and now seems to be starting the downtrend. So the ADX hook, together with other confluence factors, is already such a great piece of information that you must be aware of. Next one is the very classic high and low shift, and although this sounds simplistic, it is very important, especially when we combine it with the other things that we are learning here. So what do we see here? We are obviously in a downtrend, and how do downtrends unfold? Based on Dow theory, Elliott wave theory, and any classic trend theory, in a downtrend you'll see that the market is making lower highs. So here you can see when we could just connect the highs, you can see they are always going lower, lower lows and lower highs. We have a trend line and then something is changing here. The market is suddenly not able to make lower highs, and here you can see we are even breaking above a height. So this is a very, very important piece of information. You can see that afterwards, whereas previously the market made lower lows and lower highs, here was the turning point. The market made a higher high because here are the previous highs. We also make higher lows, which is very, very important, especially if it happens together. Then we are breaking above this high, retesting it from above as resistance, same as what I talked about with the pivot points. When you see that suddenly the resistance and support flips in a trend, that's a good sign that the market powers are also turning. And then you see that in this uptrend, suddenly it's a totally different story. We're making higher highs, and previous highs are now retested as support. This is a very, very good pullback mechanism and very helpful to note. So pay close attention to when the highs and lows are shifted, when support and resistance flips, because those are very critical pieces of information. Next on the list is the Bollinger Band rejection. So I added the Bollinger Band. The default settings are 20 period and 2.0 standard deviations, and this is how it looks. You have the Bollinger Bands. And what do you want to see is the market trade outside of a Bollinger Band. However, this is not a rejection. When you see that the market is trading outside of a Bollinger Band, it only means that the trend is very, very strong. So don't make the mistake to go against the trend just because the market is outside of the Bollinger Band. Don't go long, don't go against it. That's a very, very big mistake. Just wait a little bit longer. And if you see that suddenly there's a lot of bullish momentum flooding into the market, here you can see an engulfing candle. That's a good sign that something is changing. Now you can see the bulls are flocking into the market, and we are back in the Bollinger Bands. This is the Bollinger Band rejection that I'm referring to. And you can see the market made a complete reversal into the opposite side of the Bollinger Bands. If you see that a Bollinger Band is completely being reversed from trading outside of the low end to now reaching the high end, that's a very, very strong piece of information. This is often foreshadowing a complete trend shift. So this could be now the turning point where the market is going from downtrend to uptrend. We can see that afterwards the market had a first consolidation pattern, and that's very normal. Trends don't go just in one straight line up and down, but there's always this back and forth. And you can see the market is now making a significantly higher low, which is a very important piece of information, because previously the market only made lower lows. Now we're making a higher low. We're trading into the outer Bollinger Bands, and now a rejection and a move away out of this pattern could lead to another impulsive wave. And this is then where you find the best trading opportunities. In terms of Elliott wave, this would be considered wave 3. So this is wave 1 where the trend reverses. Wave 2 is the first consolidation, and wave 3 is the second impulsive wave in a trend. This is usually where you find the best trading opportunities. And you can see this is what happened afterwards, and then the market moved sideways a little bit. But the Bollinger Band spike together with Elliott wave theory is a great, great starting point to really enhance your chart reading skills. Every time I talk about the triple tap, people are so interested in it. So if you want to learn a little bit more about the triple tap, let me know in the comments as well, and I can make a dedicated video just about the triple tap. What is a triple tap? As the name suggests, it consists of two things. First, something with a count of 3 and a tap. So we have 3 taps, tap, tap, tap. And in an uptrend, you will see that the market is making a higher high and a higher high and a higher high. Okay, yes, technically those are higher highs, but just looking at the high structure, there's a huge thing happening here. So whereas previously the market was easily able to make a higher high, from this high to this high, the distance was already much shorter. And from this high to this high, price was just barely able to get above this previous high. So we can see that the momentum is clearly changing, and the bulls are not actively interested in this anymore. So a triple tap is the first sign that the previous trend is losing a lot of momentum. You can see when we zoom to a lower time frame, we can see it as well. If you add, for example, an RSI, an MACD, a stochastic on it, you will get a divergence here and here as well. So a triple tap is technically also a double divergence if you're using a momentum indicator. What happened afterwards is that the market broke below the lows and retesting previous support as resistance. I'm pretty sure that if you add, for example, the pivot points, you will also see that change. The market trading above the pivot points and then trading below them. And you can very nicely see how you can now start building very nice confluence strategies. So pivot point rejection, we have the triple tap with the divergence and a break and retest approach. And you can see afterwards the market really rolled over and started a new downtrend. Fibonacci's are used quite a bit for automated trading strategies and also for algos. So if a Fibonacci sequence has been completed, it often leads to the end of a trend and sometimes even to a reversal. So what does it mean? So here you can see we draw the Fibonacci, point A at the beginning of the uptrend, then point B is the end of the first impulsive wave. Point C in this case is a very nice 38.2 retracement, and then point C is in this case the 200. And you can see that afterwards the trend seems to be over and the market is rolling over. So if you can find a completed A, B, C, D pattern, that is first of all often used for targets, and you cannot and you should not expect too much more after the 200 has been reached. Of course, there are some exceptions to the rule, but generally trends often end at 161.8 or 200. In this case, you can see we have a very, very deep retracement. So A, B, C is a very deep retracement. And then here you can see the market already ran out of steam at the 138 retracement. Here, if you draw a support and resistance, by the way, on this, you will see that you have a nice trend line. And then the market rolled over, break and retested the structure and turned around. Here, an example in a downtrend, we have wave A, B, C, 23.6 retracement. And then in this case, you can see the market stopped a little bit at 161. We had some issues at 200, but in this case, you can see here was the divergence, here was the 261. So just because the market is reaching a specific Fibonacci extension, it doesn't mean that the market is automatically going to reverse. I would always add more confluence rather to improve your chart reading. So first of all, you could add the Bollinger Band rejection, you could add the pivot points, you could add a moving average, you could just look at classic support resistance. Here the market was still always making lower lows and lower highs. Here was the first time then that the market made a higher high as well. Here's a divergence. So that is then how you improve your chart reading a lot. And obviously we cannot complete a trend and a trend turn video without talking about divergences. So here I added the RSI 14 period, and you can see in this uptrend the market made higher highs and higher lows until here we have a divergence, higher highs and lower highs on the RSI. This is a very, very important signal because the RSI looks a little bit deeper into the candlestick size, the closing prices, and the RSI detected that the closing prices, the candle size, and the amount of bullish versus bearish candles has changed here compared to what has happened previously. So the market is picking up that the momentum is slowing down. You can see when we look at the high and low structure, it also changed. You can see that the market started making lower highs, it broke through lows, which it never did before. So when the market is breaking into a new lower low and also making lower highs, this is often the sign that the market is turning around. And by the way, this is what I refer to as a dirty retest here and here as well. And I made a video, I think it was my second last video on my YouTube channel, so make sure to check my previous videos on how to trade a day trading strategy with a dirty retest. It's a very, very interesting strategy and adds and works nicely here in this context. Another example, the market make a higher high. You can see price action gives us a higher high, and the indicator is giving us a significantly lower high. So there's a huge discrepancy between what is happening on the price chart and what the indicator is in reality picking up. And you can see we are already making a lower high, which is very, very important. That is not something you want to see in an uptrend, especially when it comes with a divergence. And you can see when we go to a lower time frame, this is where the higher time frame divergence comes in. Here's the lower high. Here's where the market then breaks through a low, comes back, retests the structure, and then the downtrend unfolds. So a divergence is often nicely used in a multi-time frame concept. You find a divergence on the higher time frame, you find other confluence to support your trading idea, and then you can go to a lower time frame to fine-tune your trade entries.